nothing substitutes for actually meeting sponsors face to face. But at that live event, you're also going to meet other passive investors, most likely, that were in your shoes a year or two ago and are now doing it successfully.
Welcome to the Creating Wealth Podcast, where Kyle Curtin takes you on an extraordinary journey alongside renowned multifamily real estate experts from every corner of the United States. We teach you how to harness the power of real estate investing and witness the transformation of your wealth building strategy. Let's create wealth together.
What's up, guys? Welcome to episode 122 of the Creating Wealth Podcast. I am your host, Kyle Curtin. I'm a co-GP specializing in investor relations and capital raising for multifamily sponsors. Today, we get the great pleasure of chatting with Jack Krupey. He is the founder and principal of JKAM Investments out of Puerto Rico. Jack has an incredible story with over 20 years of investing experience, from joining a private equity fund, acquiring $3 billion worth of mortgages in 2008, to starting JKAM Investments in 2019, and so much more. We're super excited to have you on here, Jack. Welcome, my man.
Thank you so much. It's great to be here. Thanks for having me.
Of course, definitely. Yeah, so let's jump right in, man. Kind of tell a little bit about your backstory, how you, kind of initially got the bug for real estate and that type of thing.
Sure. So the least glamorous part, which was not in my bio, is that I started buying single and two family houses in Rochester, New York, right after college. I'd read Rich Dad, Poor Dad. It was a high school graduation gift for my aunt. And then, I graduated during the dot-com crisis. So I went from thinking I was going to be this, high-powered computer consultant, making tons of money on stock options and everything to, luckily I had a job, but it was not as exciting as I thought. It was really, the job market wasn't good. So I went to Las Vegas for my 21st birthday, and I bought one of those books. I saw the money and the glamour in Vegas, and I was like, I need to figure out how to do something, how to build wealth, make more money. So I bought one of those paperback books, How to Make $1 Million in Real Estate, read it cover to cover on my flight home. And I'm like a 21-year-old kid. I called my college landlord. I still had a couple of roommates, and my landlord was a broker and owned some rental properties in Rochester. And a couple months later, I owned a house, no money down. And then another 2 months later, I had another one. So I basically lived that infomercial dream, did all the traditional, flipped a couple houses, wholesale, short sales, buying at the courthouse steps, and, built up almost 50 units over a few years, and quickly realized that it's really tough to scale the single and two family. I essentially created myself a job that I didn't really like. And, I caution a lot of investors, now that, the multifamily, the syndication space, especially if you're already a high earning professional, it's not as easy as it seems. And often you're creating yourself a job, and you need to be cautious of really what your hourly rate is for your current business. So after the 2008 crisis, it turns out that Wall Street was buying a lot of non-performing loans. They were buying portfolios of them, and they needed real estate people. So I grew up outside of New York City and New Jersey and always wanted to live in the city. And I ended up moving into Manhattan December 2008 and worked for a private equity fund buying non-performing mortgages. So I was in at the bleeding edge of the crisis, and there were portfolios we bought. We bought a portfolio of second mortgages for 3 cents on the dollar. And it was, again, we at the time, you didn't know how many, 90% of them could have foreclosed. We didn't know, but it turned out with the government pushing on modifications and just the overall real estate market rebound over the years, some of those loans got paid off in full. And many of them were sold a number of times since, but it was probably the trade of our lifetimes if we'd had the foresight and the money to be involved. So was at a firm for about a year and a half, went on my own, partnered with a small family office, and then eventually partnered with a private equity fund, and we bought over $3 billion of loans. We transacted with Fannie Mae, Freddie Mac, buying directly. We worked with Goldman Sachs and Nomura. We issued securitizations of our reperforming mortgages, and I actually met a character from The Big Short during my time in New York. The character that worked at Deutsche Bank, he runs a fund, and they were actually buyers of our bonds. So
Wow.
To some extent, they were the cause and the solution of the financial crisis, because those are the bonds that blew up. But years later, they're actually still buying them, and they were buying much higher quality bonds because we had re-underwritten the deals. We had made deals and modified and cleaned up a lot of the loans, and ours were actually a high quality product at that point. So it was a great ride for me, and I was making more money than I had ever had in my life, but I was living in New York. I was paying a 50% plus tax rate when you factor in the federal, the city, and it was not structured as, a lot of real estate investors pay minimal taxes because of the being able to take advantage of real estate depreciation. This was all ordinary income. So I was really burnt out and wanted to get back to the reason I got into investing was to have that passive income and lifestyle as opposed to just grinding on Wall Street. So I left as an employee in 2019 and then was eventually bought out. And I'd already been investing in syndications for a number of years passively. And once I had a pile of money of my own that I wanted to invest and was going to put a lot of it into syndications, a number of my investment partners really walked me through that co-GP model, if you're a fund to funds model, depending on who you talk to, and really explained to me that, if you're writing you don't even need to be writing a gigantic check, but just a slightly bigger check than that person putting in 25 or 50,000. And if you could add value and be consistent to, investing on majority of the deals, that there's room to get much better economic terms, or whether it's through a better split or through a piece of the GP. And that's really what I've been focusing on for the last few years is helping investors like myself that, are accredited and looking to move outside of the traditional financial system, the wealth without Wall Street, if you will, and really just kind of creating my own, tribe of investors that, we invest in primarily multifamily, but also some storage, mobile home parks, student housing, really all of the asset classes that, all of the syndicated asset classes. That's really our primary focus now, is just sourcing and finding good opportunities to invest.
That's incredible, man. Holy crap. What a story.
Yeah, I tried to go as quickly as possible, so I probably went 5 minutes without taking a break, but appreciate you listening.
That was phenomenal, man. Seriously, and I mean, especially even like, going back to, the days of 2008, and especially literally like being within the coals of the fire, of kind of the central aspect of that entire like time period, and that's crazy, man. Wow.
Yeah, I wouldn't have traded the pain, even though it was painful at the time. Luckily I was relatively young, and Rochester was not Phoenix or Vegas. The prices didn't really go up as much, but I certainly was affected. I mean, everything froze. We had a lot of investors from California and New York buying in Rochester, and they were using their cash out refinances from their properties in California and New York, and that all dried up. So, the market certainly froze. And, some of the biggest perspective I think has helped me over the last year or two is that, real estate doesn't always go up. Interest rates aren't always going to be close to zero. So, that perspective of seeing when things get bad is that never goes away. You need to learn from the scars for that. It's really tough to have unless you've really lived through it.
Yeah, no, I can definitely imagine, man. Like feeling the stripes. I definitely feel you when it comes to kind of like the landlord aspect as well. Me personally, I just have a 3-family in like central Mass, because I'm in like eastern Massachusetts. And I mean, even like exactly, man, from like a scalability perspective there, like even like 3, just managing 3 units, I'm like trying to delegate myself out of it and use systems to get out of it. You know what I mean? And yeah, no, absolutely. And I mean, I fortunately got in a couple of years ago at like 2.6, and I couldn't even imagine like trying to get the build into cash flow now at like, 6-7%, whatever like traditional debt's at now. You know what I mean?
Oh yeah. It's pretty crazy, but at the same time, if a deal works with today's interest rates, there's a ton of long-term upside for a future refinance down, but you shouldn't stretch. You never go in with negative cash flow unless it's a heavy value add to the point where you could raise rents in a few weeks, or it's like mostly vacant. And but yeah, I think you don't want to chase with negative cash flow with rates this high. And we are seeing prices move. It's certainly not a it's nothing like 2008. I've had many conversations with investors like thinking they're just going to sit on the sidelines and wait for a crash, but it's different this time around. There's a quote by Howard Marks, who has a whole book on market cycles, and it's history may not repeat itself, but it does rhyme. And there's going to be some pain, but it's not going to be in the residential space. There's just not enough supply of single family houses. There's so many people, like you just mentioned, that are locked at 2-point-something%. I think roughly 70% of the population either has a house paid in full or is locked below 4%. And those people are going to stay. And what that does is that'll prop up the rental market. And look, there's a few markets where rents may need to adjust a few percent, just that we're, maybe overshot with inflation, but especially in the workforce housing, middle-class housing, those rents we found are stable and still growing. I think a lot of the headlines that come out are really the high end of the markets that, are impacted by, the recession, some of the tech jobs, but the affordable housing market, the, rents from $900 to $1,300, $1,400 have still been strong, largely across our portfolio.
Yeah, no, absolutely, man. And I think this might be kind of a solid transition to how are you kind of navigating, investing in today's market cycle, especially after being through, some of the events of the past, and kind of having those as reference points, to, I guess, kind of like continue in the market cycle now.
Sure. So, I'm a big fan of being diversified, and, especially since we're not the day-to-day operator ourselves, we're partnering with a number of very experienced operators, having that diversification both across operating partners and across areas. We do focus primarily on the Southeast and Sun Belt, but we do have a smattering of properties, and we have a deal in Indianapolis. There's a deal in Dayton, Ohio. So we've got a mixture of, high growth markets and the slow and steady markets. We have a mixture of fixed rate debt, which, at the time, a few of those investments on paper looked like a lower IRR because it was 7-year Fannie Mae debt. And it's really, it's tough to get that, 20% plus IRR when you're holding for 7 years. But, another, pretty common quote is you can't eat IRR. So ultimately you want a good profit multiple and you want cash flow. And those deals, thankfully, are still cash flowing like crazy. We're locked in. And if we do want to sell some of those loans, we may even be able to sell. We still may be able to sell early with an attractive cap rate because the loans are assumable. Mix that in with some loans that some deals that we look for significant upside. We are in some bridge loan deals for all the pain of some of the bridge loans right now with interest rate caps. There's also, there was a method to the madness of doing those loans because you build in the construction reserves and you have the ability to sell anytime without gigantic prepayment penalties. So, we're in some deals that are not cash flowing like I'd like, but, we're still at a stage where, we have caps in place and we have another year to continue to renovate. And the hope is we just renovate our way out of any current issues with cash flow and, our position to either sell or refinance into a new loan that will certainly drop the rate from, where it might reset. And as far as just always networking, looking for new sponsors, new deals, new asset classes, looking outside of just multi as well. We actually made an investment into a marina, which was probably the most off the beaten path investment. And it's a marina with RV parks. And it reminds me of self-storage 10, 15 years ago. It's a lot of mom and pop owned. It's not at a level where institutional investors can come in and buy because they're too small. But if you pull together 20 of them over the course of a few years, private equity is very interested if you could sell them a large package of deals. And it's very unsophisticated sellers. One of the stories I heard was the boat slips were each Post-it notes, and they had a Post-it notes on the board of the name of the person with the boat slip, and the checks like 5. It's like almost like the Roman numerals, like check, and then across. That's not Roman numerals, but that's the way they were counting if they paid for the year. Those are some of the things we're doing. I mean, I certainly don't have everything figured out by any means, but we're diversified. We've got great quality partners, and the biggest challenge has been interest rates, but luckily, we're not only we're in a lot of fixed rate deals as well. And, that's helped us a lot over the last 6 to 12 months.
Yeah, no, 100%, man. It's one of the operators in super local to my market is into RV parks a little bit. I think he has one and then potentially another one or something like that. And it's I don't know too much about that sub asset class, but I think it is incredibly interesting, man. And especially listening to podcasts and hearing how that's kind of a pretty nice alternative type of vehicle alongside multifamily, self-storage, that type of thing, as another asset that you can leverage, and I think it's super cool. Are there do you guys have any particular markets, I guess? Are they kind of scattered throughout the US, or I'm just not too familiar with them, to be honest?
Yeah, so those are actually in Tennessee, and they're also looking in Texas. This particular operator is generally focusing on freshwater marinas, so kind of that RV lake boating culture, and not as much on the coastline ones. And that's also, some of the coastline ones are much more expensive, and those are an area where private equity is, it's a little bit more of a fit for private equity. So they're not targeting things in Miami or Fort Lauderdale or Tampa that are these giant markets. It's the regional markets where where they're affordable, and where it's generally a mom and pop owner that, much like these other asset classes, a lot of them have owned these 20, 30 years. They don't want to raise rents because they are in the community themselves and don't want to have their neighbors giving them a hard time for jacking up the rent. And, but yeah, I mean, there's tons of lakes and, in across the Midwest and Texas and the Southeast. And, it fits with the other, just the other criteria why we like multifamily. I mean, the average boat buyer is 58 years old. So it goes along with, the baby boomers retiring, the general population move to the Southeast and the Sun Belt. And, it's generally an affluent asset class too. That's the other thing. When you're doing with a class C or B- rental property, you're dealing with your tenants are, working class, not always immune to economic issues, but someone who's buying a boat is usually, has some reserves, has some capital, and, a lot less likely to be, collecting, or chasing people for late payments when they already own a boat.
That's a good point, man. I never really thought about that. Kind of like the actual demographic that, is like a tenant in those type of facilities. Drastically different.
Yeah. And this is something, I've, really just was, found about, less than a year ago. So we really dove in deep and started learning about the asset class, made an investment in a prior fund vehicle. And, there's a new offering coming out. So there's a few new acquisitions. So, we're certainly going to continue to invest in that space. And one of the bigger reasons is there's a lot of investor demand for more current cash flow. One of the challenges with multifamily, recently over the last few years is just the first year or two, there was minimal cash flow during the value add. And a lot of our investors, would rather take current cash flow now, even if it's a slightly lower overall 5-year return. So to meet that demand, we're trying to find deals that cash flow day one, that have slightly higher entry cap rates and a little more consistency. Yeah,
no, I think it makes a ton of sense, man. Absolutely. And yeah, it's extremely interesting. So in terms of, take us kind of through the fund of funds model, I guess. How did it kind of come about as a potential option that, made sense for the vision that you guys had, as well as kind of how you find other operators, partnering with people, that type of thing. I know that was kind of a lot, but
Sure. Yeah. So, the fund of funds model, I mean, a lot of the people I knew from my time in New York, were accredited investors, were in that maybe $1 to $10 million range where, they had significant assets, but a majority of them had 90% of their money in the stock market and really were not aware even of the, all the options for alternatives. And, as I was talking with them, to make your first syndication investment, I mean, it's pretty daunting. And then you have to pick, do you want to be in Texas? Do you want to be in North Carolina? Do you want to be in Florida? And then which operator do you pick? And, the ones that do jump in, usually it's somebody they know, somebody they met. My first investment was somebody I met at a RIA in New York. He was from New York, but he was investing in South Carolina. And, I'd known him for a few years and eventually jumped into one of his deals. So one of my goals is to make it more accessible. And so my fund of funds, if you will, and we have two different funds we run currently, but one is a truly diversified fund that we leave open for 1 to 2 years. And we consistently raise money and we consistently invest in different deals every month. And so if an investor comes in day one, they know that they're going to be able to dollar cost average into multiple assets and have a diversified portfolio. And then once the portfolio is built, there'll come a point we'll close and just open a new fund, just because you can't just keep it opened. If you keep it open forever, then you need to get into all the valuations of things. So we do it as a closed-end fund that we leave open for 1 to 2 years, and investors that come in late get the benefit of seeing the assets that are currently in the fund. And we negotiate preferential terms almost across the board, whether that's a better split. Many sponsors, if you're putting in 50,000, you might get a 6 or a 7 pref and 60-40. If you're putting in 500,000, you might get an 8 or 9 pref, 80-20. Mm-hmm. Other sponsors, and you mentioned co-GP, other sponsors will, if we're moving the needle for them and we've invested consistently, will actually make us a legitimate co-GP in the deal. And what we do in that case is we actually will rebate that to the fund. So the fund itself is the co-GP. And so that means the fund is going to generate a much higher return. So a lot of investors are fee conscious when they hear fund of funds, but our goal is to offset a majority, if not all, of our fees. And if one of the co-GP deals goes parabolic and we crush it and make a crazy return on it, it's not out of the question that the fund would actually do better than the individual deal. And on top of that, you have diversification across multiple deals. So that was my original vision, was to really just give people the ability to diversify on their first 100,000 invested.
Yeah, no, I think it makes a ton of sense, man. Especially being able to leverage, kind of like the operators that super well, and the deals that super well in a sense, and be able to like really leverage the experience from across the board, and exactly like not just kind of taking like a needle approach, but being able to diversify across separate different deals at the same time.
Absolutely. And then to the second part of your question about how we source deals, I had a few operators that were grandfathered in that I'd already invested with successfully personally. So that they were some of the early investors. And then, I'm in a number of mastermind groups. I attend various conferences. So over the years, I've, met new sponsors. There's a lot of referrals from other investors, other people in the industry. It's never happened where someone's cold calling me or just sending me an email and we're investing in their deal anytime soon. It's because I think in general, there's really way more deal flow than capital available. And we're still growing our tribe and our base of investors. But we have the benefit of, we've allocated to at least 15 different sponsors. Each of them look at 200 plus deals a year, and maybe they find 2 or 3 good deals.
Yep.
So out of a few thousand deals across the board being looked at, we're getting sent maybe 45 deals a year, and then we'll pick between 10 and 20 to potentially allocate to. So we are really seeing the best of the best, and the operators are doing a lot of the legwork for us. And one other clarification, because I mentioned we have 2 funds. In addition to our fully diversified fund, we did launch a separate platform that's still a fund, but it functions more like a crowdfunding platform where you could actually pick individual deals and you're only invested economically in that deal.
Gotcha.
So that includes multifamily, and we also have a few hard money or private lending funds up there as well. So there's multiple options, and you really can just pick and choose what you're interested in. And it's only one private placement though. So once you're in the fund, you just basically use the web portal and you can pick and choose, allocate new money. If something has liquidity, you can withdraw, but a majority of these do have lockups because they are syndication deals. But that's really solved a major problem for us, because we had a lot of deals where if it was only a few $100,000, it wasn't worth doing a private placement for it. And selectively we would refer investors, but we want to continue to stay in the loop and make sure our investors are taken care of, make sure they're getting their distributions on time. So it really solved a major problem for us on just deals that weren't large enough to do their own PPM, and we're pretty excited about it. So we tend to market deals, but then we have the diversified fund as well. So we're really, kind of, sometimes we seem more like a syndicator operator, and then sometimes we seem like a diversified fund. So it's kind of a mixed message, but it works and people have multiple options.
Yeah, no, that's incredibly cool, man. Absolutely. Just to be able to have that, like, have the choice in a sense, for investing in that fund and being able to actually allocate, as you please, as an LP. How do you define wealth?
So I think it's a combination of, having enough money to be comfortable that you could actually live the lifestyle you want. Because you could be mega rich but not have wealth if you don't control your time. And I've lived through that myself as well. So it's enough to have control and freedom if you want it, but I guess enough to have control of your own destiny.
I love that, man. Absolutely. It's always fun to hear like what people's definitions are of it, but like most of the time, like 98% of the time, it revolves around that like abundance and time freedom, and control in different parts of your life and that type of thing. And it's always extremely interesting.
Yeah, absolutely. I love that question.
Thank you. What was one life-changing piece of advice that positively impacted your development in business or life? If you had to pick one.
It's kind of along the lines of that one, but in 2007, early 2008, I was still in Rochester. Was kind of struggling, trying to figure things out, and a business partner at the time, says to me, "You don't want money, you want freedom." And that was, I had never really thought of it in those terms. And it still took me another 10 years, but it was part of, it was one of those decisions of, am I just going to grind it out in Rochester, New York? And I've no doubt I would have made a living, but I was, kind of wanted something bigger. And that was, part of the steps to actually, move it down to New York City. And, the next step was literally finding a job in private equity on Craigslist, believe it or not. That fund, put a note out on Craigslist looking for real estate people to help them. So you just never know, what you fall into.
Absolutely, man. That's incredibly cool. I mean, especially like, finding that W-2 position in like that, private equity world and kind of, seeing things from that angle, especially at that particular, point in time. If you don't mind me asking, like, what did kind of like a day-to-day look like in that job, like kind of working for that firm?
Yeah. So early on, because we were buying non-performing seconds, it was a lot of just trying to figure out what's happening with the first mortgage. Is it foreclosing or not? Trying to do soft credit pulls when you could. And then, we had thousands of them. So trying to just figure out which batches were working. I was talking to borrowers in some cases. So trying to figure out who could we modify, which loans had equity. And it would really vary week to week, but over the course of a year or two was doing all of that, ranging from actually talking to borrowers, making deals, saying, hey, this person can afford to pay, let's modify this loan, versus getting valuations. In some cases there were deals that still had equity where there were so many home equity lines of credit taken out that it was not uncommon to have a $500,000 house with $100,000 first and a $400,000 home equity line of credit that was in foreclosure. But sometimes they were still paying their first. And then we also sold loans. So we were also dealing with other investors that we would get a loan reperforming and we would sell it to them, or we would sell the non-performing second lien and then someone would finish the foreclosure and take the REO. So it was all across the board, along with legal, talking with foreclosure attorneys. As we grew, and by the time I was at the fund and we were doing $3 billion, a lot of my time was unfortunately stuck on collateral. These mortgages were bought and sold multiple times. And when you buy a portfolio, it's not like you have a closing and you get everything. you basically have a contract with that says you're going to buy 1,000 loans, and it could take months to get all of the collateral delivered and the assignments assigned from one bank to another. So that was, not the most joyous thing, but it was, some of the things that needed to happen. And then coordinating with loan servicing companies and foreclosure attorneys, because once we're at that scale, there was a third-party servicer that was talking to borrowers. We weren't getting on the phones with borrowers ourselves at that point. And but we'd have hundreds of loans that we needed to decide what to do, approve things, move them to the next step of foreclosure, liquidate the REOs. So it was a pretty pretty full job. And none of what I'm talking about is including like the finance side of the Excel modeling, because that was, I can get around Excel, but I'm far at that level. It's almost, it's like investment banking. There's these insane Excel models that, had 15 different tabs and all the inputs, and, basically all the investment bankers dealing with the end financing and the securitization. So it's a pretty crazy business. And, it still exists, but, the golden time was sort of that, early, 2010, 2014, 15. Eventually, a lot of the bigger private equity funds got into the space and returns started dropping, much like large commercial real estate. Wasn't tracked on a cap rate basis, but certainly big money started coming in, and the returns got a little more normalized.
Wow. That's super cool, man. Damn. So I do want to bring us to our last section here, my man. This is the action steps for abundance section of the podcast. So he's going to share 2 immediate action steps for 2 dominant demographics in our audience that typically listen to the show. The first one, what is one immediate actionable step for someone on the fence about passively investing in syndications, alternative assets, really just, kind of jumping in and passively from different angles?
Gotcha. Well, assuming you're already listening to this podcast and maybe you have others on your playlist, you got to go to a live event. Nothing substitutes for actually meeting sponsors face to face, but at that live event, you're also going to meet other passive investors, most likely, that were in your shoes a year or two ago and are now doing it successfully. I often talk about active passive investing. I go to a lot of events. The passive part is, if you invest in a syndication at scale with a good operator, you're not getting that 2 a.m. phone call because the toilet's clogged. Yeah. But you do need to put in the work up front and just going live. I'm going to, I'm going to go to Rod Cleef's in Orlando in September. I'm going to, Lone Star has an event in October in New York City. There's tons of events. There's Jake and Gino. There's IMN. There's an event pretty much every month in some corner of the country. So no matter where you are, you could probably get to one within a few hours. And if you're in the Northeast, there's plenty of events in areas with nice weather in the winter. So you just got to go. There's no substitute to get to the next level of just talking to real people who are already doing it.
100%, man. I love it. And it's funny you say that about the events, because that's something that I'm, just kind of starting to get into, and kind of, starting to make it a habit of going to a couple every year. And I was actually looking at Rod's with my partner, Brian. And then there was one that I literally just heard about, like right before we jumped on the call, in New York, November 4th. I think it's like MFIN or something like that.
Oh, okay.
And I'm
I've heard of MFIN.
Yeah, sorry.
Oh, yeah. I didn't know it was November 4th, though. I might actually, I might look into that one as well, because I think I'll be in the Northeast. I, still pop into New York and New Jersey, relatively often.
Yeah, no, definitely, man. And I was looking at it and I'm like, that could be a day trip for me. I'm like, that's probably like, 3 hours that way or something like that. I'm like, let's do it. Why not? What the hell? You know?
But yes, you want to stay overnight because you don't want to miss the happy hour and the networking. And that's the other thing too. That's a lot of deals are going to get done, at the bar afterwards. So it's, don't skimp and take the train or the bus back at, or drive. Don't want to deal with Manhattan traffic. Stay at least, the night before, the night after the conference, and really get the full experience.
That's a good point, man. Yeah, absolutely. I was thinking about it. I'm like, I could make a day trip out of it. I'm like, I could leave Mass at like, I don't know, like 4 in the morning or something like that. Like get there by like 6 or 7 or like something like that. But I'm like, that makes a lot more sense, man. And like, especially like, because I went to like the Bigger Pockets event a couple years ago, and like Go Abundance event last year. And like something that I often tell people is like, oh, when you go to like conferences and crazy events and stuff like that, I'm like, it's like you're drinking through a fire hose. I'm like, so you're going to want to like give yourself like the next day off from work or whatever it is to just like process, and exactly like you said, like, you never know who, is going to be at the bar like an hour after the event or something. And it could be an ex-partner or next investor, or you never know. But
Absolutely.
I love it, man. Absolutely. And then my other question for you is, what is one immediate actionable step for GPs, or, fund of funds or what have you, to grow their business? I know it's kind of a loaded question.
Yeah. I mean, you gotta up the content game. And I was guilty when I started of not really fully committing to that. There was a number of years in New York, we weren't allowed to even go to conferences without general counsel approval because, these were not 506Cs, these were institutional funds, and there was public statements. You had to be careful about getting quoted. So it took me a little while to fully commit to, launching our podcast and to, posting as regularly. And it's the modern day for, think about 20 years ago, we would send yellow postcards out. We buy houses. And when I was young and broke, I was afraid to do our first postcard because I think it cost us $700 for stamps and to print out some yellow paper, and we cut them into fours and, paid an intern to come in and literally peel and stamp and label. So I was afraid to do that. And eventually, our first mailing, I think we made $100,000 or more on buying and wholesaling properties or buying and flipping. So, the commitment to the content, it's not natural for everybody. I'm 44 years old. I'm not the one who's like always talking into my phone on Instagram, but, I'm finding a way myself. I was in Dallas the last couple of days. I took some pictures and some videos of what I'm doing. I'm throwing them into a Google Drive. I've got an editor who helps put things together. So you just it's the modern day postcards or the modern day yellow page ads. And if you're not doing it, you got to do it because it's the way to get your message out there. And it's worked. I mean, we've got investors. It's not just the young 30, people that are 40, 50, 60 years old or on Facebook and seeing posts, and it does work, and it's not something you can skimp on. And if you're not this extroverted talk to the camera person, which believe it or not, I'm really not. I'm great on these things with conversations, but sometimes it's hard for me to just talk blindly into it myself. But if you're more of a writer, great. I mean, there's tons of need for content, LinkedIn, Twitter, even Instagram, where you scroll and there's top 10 things. I mean, there's room if you're exactly. There's room, just like in real estate, there's room for introverts, extroverts. Every salesperson needs somebody who's good with Excel and good with, the engineering side and the number side. So this is a team sport, and, you could find your niche in that, and, or find the right team and plug in with a team that's got that side of it down, and then find a way to add value.
Absolutely, man. And I totally agree with you, like with the content, and like sometimes it's difficult, right? Especially to scale it. Because like, sometimes like you're in the moment, you know what I mean? And like, oh, it's like, oh shit, like, I should take, a couple pictures, some videos, for Facebook and stuff like that. I'm trying to get a lot better at it myself, including like really doubling down on like the podcast as a medium. I'm really trying to stick to like podcasts, like, and putting out a lot more content for that platform, and then like Facebook as well, and like a Facebook group or whatever. But I hear you, man.
One of our goals for the quarter is to grow our Facebook group, and we don't have an exact date yet, but we're working towards a virtual summit, which will be a number of similar to podcast interviews, but we're trying to really focus on the, just the mindset and the kind of explanation of alternatives to some of the tax and self-directed IRAs. So we're really trying to work together to sort of a really curated summit that, we can record that can really help investors get from 0 to 1 to invest in alternatives. And those that are already in it, there's going to be some value. I mean, there's never enough information on how to properly structure like a solo 401k and different tricks and tips. So there'll be something for everyone. And we're kind of working on the early planning stages, but we're on the same page with growing just growing our following, try to provide as much value as possible. And, that will be, returned tenfold, when you've provided the right value to the right potential investors.
Exactly, man. And to your point as well, of exactly like you mentioned earlier, like if, say like kind of like figuring out what the medium is for you, like you said earlier, like if it's like writing and like copywriting, like maybe you could like write blog posts or, like write descriptions and stuff for Instagram for somebody or that type of thing, as well as, I won't go down the rabbit hole too deep, but of leveraging, like virtual assistants. There's a couple folks that work alongside me. Shout out to Kathleen and Christian. Love you guys. But essentially, like, there's a lot of different ways to be able to just find the pieces that don't complement you, both in the real estate part as well as in the content and production part as well, while also keeping in mind, the value of your time and, the dollar per hour activities and all that fun stuff. There's a lot of ways to do it, and I love it.
Yeah, absolutely. So yeah, I mean, we have somebody who edits. We have an agency that edits the podcast when we do them, and I know we have a mutual contact who linked us up for this, and I know they'll put together some clips. I'll grab clips myself, and just if I hear something I like, I'll send it to my team. And sometimes we've made extra clips for podcasts we were on if I thought I had a good talking point and thought, or even if it's timely. Sometimes I go back a couple months and I think about a prior podcast if something happens in the news, and I have this random memory. Like, I can't remember to pick my socks up off the floor, much to my wife's chagrin, but I have this random memory for random facts, often useless, but occasionally very, very timely. So
I love it, man. Absolutely. Thank you so much for coming on here, Jack. Where can people contact you? Like you, the company? I know you have a kick-ass website. Yeah. I was looking at it earlier.
So yeah, the website is JKAM Investments. That's JKAM for JK Asset Management, jkaminvestments.com. We're on Facebook. We are trying to grow our Facebook group. Podcast is called Alternative Investor Mastermind. We'd love to have you on the show sometime and hear your story as well.
Love to.
And we're on Instagram. We're on it's basically Jack Krupey on most of the platforms, and then JKAM Investments as well. So whatever your platform of choice, reach out. I think we have a TikTok. I don't do a dance video or anything, but I think some of the Instagram content probably goes on TikTok as well.
I feel you there, man. I'm right there with you. But awesome, man. Yeah, I'll tag all that stuff below. Thank you so much for coming on here, Jack. This was freaking amazing. And
yeah, I really appreciate it. Had a great time. Hopefully we can do it again sometime.
Absolutely, man. Thank you so much.
Thank you.
That's a wrap for today's episode. We want to thank you for being a valued listener of the Creating Wealth Podcast. Make sure to visit www.creatingwealth.com to connect with us. Dive into our ever-expanding library of informative blogs and explore a wide range of additional valuable resources. Stay tuned for our next episode as we continue to create wealth together.